Hi folks, welcome to this short video on question 1 of your review. Now, one thing I recommend you do is that you have the question in front of you as we're going through this video, because I won't be hopping back and forth between the question and the solution. So let's begin. This question asks you to do a calculation of consolidated net income, and it is important that you know how to do that because that acts as a check so that when you do your consolidated income statement, while this question didn't require it, but if you did in practice, you would have a check digit to know whether or not once you completed your statement you actually had the right number. Now, in our question, we are given a wide variety of intercompany transactions. We have some that deal with inventory, land, and fixed assets, as well as dividends. So let's begin. In our question, we're told that the parent acquired back in X1 70% ownership of the sub. We see that in the additional information, we know that there were some intercompany transactions. For example, if we look at item number 1, we can see there that during X5, when the parent was selling to the sub still had $17,000 in profit sitting in the ending inventory that it had not yet sold. We also see that in that same year, when the sub sold to the parent, and again we can get this from item number 2, we see that the parent still had $8,000 of intercompany profit sitting in the ending inventory that it got from the sub and it couldn't sell. So we know that together $10,200 will adjust the parent's income when we calculate consolidated income this year, and $4,800 will adjust the sub's income when we calculate consolidated net income this year. And both of those amounts will decrease the respective entities' amount that they've recorded for income or profit this year. We also know that from a previous year, in X4, we notice that the parent sold to the sub, and the sub has not, as at the end of X4, the sub had not yet sold inventory that had $11,000 in pre-tax profit in it. Now, because we are in X5, this amount of after-tax profit will be shifted into X5 because we make the assumption that because inventory is a current asset, unless we're told otherwise, we know that that inventory during X5 would have been sold outside by the sub outside to a third party. So this amount of $6,600 is actually going to be adjusted to the parent's income to adjust it upwards this year to record that profit for the consolidated entity. Now, we're not going to literally adjust the parent's income to take in $6,600 or adjust the parent's income literally to remove $10,200, and we're not going to literally adjust the sub's income to remove $4,800 in profit. Each of those entities have legitimately booked profit in the proper year. What we want to do is recognize it when the consolidated entity can actually book it. So now we'll look at the land transaction. Now, the land transaction is indicated to you in item number 4, and we know that in the current year, X5, the sub sold the land to the parent. The sub booked profit pre-tax of $12,000, and now $7,200 in after-tax profit is what needs to be removed from the sub's income this year, not literally, okay, just to facilitate the consolidation calculation. We also notice that in a previous year, X3, the parent had sold some equipment to the sub. At that time, the parent booked profit of $28,000. The book value was $60,000 to the parent. They sold it to the sub for $88,000. That means that that $28,000 profit is going to be recognized by the consolidated entity over the remaining useful life of 10 years, which is the period that remains in the useful life of the equipment at the date that it was sold intercompany. What we learned in our course is that that gain of $28,000 will be taken into consolidated income over that 10-year period. So in X3, the year that it was sold intercompany, as well as X4, we take in $2,800 each year, which is $5,600, which leaves us with an unrealized balance of $22,400. And then we'd also in this year recognize $2,800 into consolidated income, which at the end of X5 would leave us with an unrealized balance of $19,600. We're concerned mostly with this year, right in here, where we would have after tax taking into the parent's income $1,680 in after-tax profit. Even though it wasn't sold intercompany that year in X5, we would take this into X5 income because we are taking into income $2,800 pre-tax a year. That's to the consolidated entity income. How we would do it is we would adjust the parent's income by after-tax $1,680 this year to take in that $2,800 pre-tax. Right? So we'll adjust the parent's income by $1,680 upward to be recognizing some of that profit to the consolidated entity. So now that we've analyzed our transactions, let's start our separate entity income adjustments. And what we see here is that the parent's income was $99,000. We have that right in additional information item 6. But that includes the parent's share of the dividend paid by the sub. Sub paid $10,000 in dividends, 70% or $7,000 went to the parent. We also remember that because we had an opening inventory profit of $6,600 when the parent sold to the sub, way back when in X4, that $6,600 in profit can now be realized by the consolidated entity because it's been sold outside in the current year, X5. During X5, the parent sold to the sub some inventory that the sub hadn't unloaded, and we can see that from our calculation, we had that at $10,200. So therefore, we would remove that profit from the parent's $99,000. The depreciation, again, as we said earlier, we would take that $1,680 into the parent's income, not literally, just figuratively for the consolidation purposes. So the parent's adjusted income would now be $90,080 for consolidation purposes. We will make similar adjustments for inventory and as well a goodwill impairment loss. To the sub's income, the sub recorded $40,000 in income in X5. We know from the question in item number 5 that there was a $5,500 impairment loss. Don't forget, any acquisition differentials that are amortized during the current period, as well as any impairment losses, are all going to be adjusted to the sub's income. So we reduce the sub's income, just figuratively to facilitate consolidation calculations, by $5,800. And don't forget, during the current year, there was an intercompany sale from the sub to the parent for inventory, right? Of which $8,000 in the ending inventory of the parent contained, that $8,000 was profit, after tax $4,800. So therefore, that $4,800 has to be removed on an after-tax basis from the sub's income this year, which we've done. Don't forget, there was also the intercompany land sale that took place this year, X5, and that land sale booked a profit of $12,000 by the sub. After tax, tax rate's 40%, so after tax rate is 60%, that $7,200 has to be removed because the land has not yet been sold outside of the consolidated entity by the entity holding it, which is the parent. So we need to remove the income from the, or that amount of profit from the sub's income. If it had happened that the parent had sold that land outside of the consolidated entity in X5, we would not be removing the profit because the consolidated entity can legitimately book it. But we have to because it isn't sold outside. So now we have adjusted income of the sub of $22,500, and we'll add that to the adjusted income of the parent to get consolidated net income of $112,580. The next thing we'll do is we'll allocate it amongst the parent shareholders, of which they get 100% of the parent's adjusted income, which we calculated as $90,080, plus the parent's share of the adjusted income of the sub, and that will give us $15,750. So attributed to the parent shareholders of this $112,580 is $105,830. The balance of the adjusted net income of the sub, which is 30%, goes to NCI shareholders, which is $67.50. So that concludes our calculation of consolidated net income for your first review question.